All right, well, thanks, Knut. So just for some context, I received a call yesterday evening from Knut, and he asked if I could just offer some words up from my perspective. And my perspective is, I guess I would say, it's the view from the tip of the spear, as I am an IAR in the field and been with my current RIA firm for over 20 years in Florida. So it's my view that arguably nothing has changed in the field. Investors remain as confused as ever. And from where I sit, Reg BI and Form CRS have made little discernible impact on the public. And if I had to say anything, I think it's really at best, just another piece of paper that they maybe perhaps throw in the corner, and at worst, it confuses the public even greater because based on my experiences, again, when people have ever brought these in, and that primarily took place right around the time when it came out, and I haven't really seen them in about a year and a half in terms of people coming in my office. They're unable to really make any distinctions with those forms. So I am still seeing Mr. and Mrs. John Q. Public come into my office with the same issues that they had prior to Reg BI. And they're always the same tales that they're a financial consultant, they're financial advisor, their money manager. So all of these terms being used universally and interchangeably, that they believed and trusted, sold them this or sold them that. I will say that I am kind of in a perpetual state of I guess I'm going to call it mild anger around the fact that that much of this takes place in the insurance world. So I'm still seeing tons of annuity products that are coming in the door that are arguably not even suitable, let alone meeting anything that would meet what is, I believe, as I certainly infer, and I believe is being implied by calling anything Reg best interest, right? So the situation on the ground is unimproved, and I realize the sample size is relatively small, but again, I'm seeing arguably 50 people every 6 weeks, and not all of those are existing clients. So in my view, people are still being misled, and nothing has really changed on the ground. People are still confused. The investing public always seem to tell me after the fact about how they felt led astray or duped. I guess what I want to say is that if you're familiar with this term, that arguably there has been a bit of a Cobra effect. And by implementing this policy, and what I mean by that is that there's a belief that it was helping something, but it arguably made it worse. And how did it make it worse? Well, it increased the confusion, or embedded the confusion to a greater extent. So people are still being hurt. Little has changed from my vantage point. I realize that, in all appropriate disclaimers, I have a particular view on this, but I would be the first to tell you that I've seen things improve, and I haven't. So why does this matter, and why do we care? Well, again, people are being hurt. I feel like that the regs, at least in the real world where the rubber meets the road, that this has been a lot of kabuki theater in Washington, D.C. So that's my view, and I think that's what Knut wanted me to provide. His question to me was really forthright and very simple. What does it look like from your vantage point? Are things any better? Are they the same? Or are they worse? And my view is they're largely the same, and potentially worse. So that's all I really wanted to say, and that's one person's view, sitting here in Florida, acknowledging our reputation as a state as well.
Thank you, Chris. Thank you for offering your background and experience. August, you're up.
I'm August Iorio. I'm a managing partner at the law firm Iorio Altamirano, which is a securities arbitration law firm based in New York. We represent investors nationwide in helping them recover investment losses as a result of broker misconduct or negligence. I'm here to offer my perspective from that vantage point. Reg BI is important to us because the obligations it imposes on brokers and firms also helps define the standard of care owed to customers when we adjudicate individual arbitration claims. So even though based on our experience, almost all retail investors believe that their brokers have a fiduciary obligation, we all know that that has not been the standard. Prior to the implementation of Reg BI, the standard was suitability. Was an investment recommendation suitable for a customer? Based on that person's investor profile, did the broker have a reasonable basis to make that recommendation? Since Reg BI has gone into effect in June 2020, we have been monitoring to see whether it has increased the degree of prudence required by brokers and broker-dealers when they make an investment recommendation from the suitability standard to something more. NASA's Reg BI report in November 2021 concluded that most firms are still operating in the same manner as they were under the suitability rule. Specifically, that report concluded that most firms continue to operate precisely the same under Reg BI as they had under the suitability rule, and that they are not providing fair and balanced point of sale disclosures regarding fees, costs, and risk to retail investors. Meanwhile, firms have steadily increased their participation in selling complex, costly, and risky products under the new conduct standard, and they continue to rely on financial incentives that Reg BI was intended to curb, incentives that we rarely see with fiduciary advisors such as RIAs. In short, NASA has concluded that firms are still placing their own financial interests ahead of retail customers in violation of the rule's chief directive. This is consistent with what we are seeing in practice in representing investors and filing claims against brokerage firms. A broker's standard of care obligation is not based on fiduciary principles. Brokers and firms will continue to recommend and sell complex, costly, and risky products that offer the broker and the firm higher commissions. Now, earlier this month, the SEC initiated the first Reg BI enforcement action against Western International Securities, which is a broker-dealer based in California, and that was in connection with selling GWGL bonds to investors. Before I discuss the case itself, I'd like to offer a little bit background on GWGL bonds to help put it into some context. L bonds are financial products that were created and issued by GWG Holdings, a company that used to be in the life settlement business. They issued and sold over $2 billion worth of these products through a network of 120 regional broker-dealers across the country. These were illiquid, risky, and speculative securities. In addition, quite significantly, GWG materially changed its business model in 2018. Our investigation has revealed that widespread failures by brokers and firms in connection with conducting due diligence to understand the risk and features of these securities, and of the issuer, and in recommending these bonds to customers. Based on our conversations with over 80 GWGL bond investors from across the country, there's been widespread failures by brokers and firms to provide fair and balanced point of sale disclosures regarding fees, costs, and risk to retail investors. Moreover, when recommending these products, rarely did any of the firms offer any reasonable alternatives to the investors. We believe that brokers and firms are incentivized to sell these securities because of the high commissions they received. You can check out more about our firm's investigations on our firm's website, gwglawyer.com. Now, the SEC's lawsuit against Western International Securities accuses the firm and its brokers of failing to perform due diligence regarding the inherent risks associated with the GWGL bonds. The complaint alleges that the named brokers misunderstood important issues regarding the GWG holdings and the L bonds, including that GWG significantly changed its business model in 2018. As a result, brokers recommended these L bonds to retail investors without a reasonable basis to believe that the investments were in the customer's best interest. The filing of the lawsuit is significant in that it confirms what we have suspected. We had believed that for some time that the brokerage firms did not have the best interest in their customers in mind, and they recommended and sold these L bonds to investors. And they failed to conduct proper due diligence on the L bonds before they sold these products to customers. After speaking with many investors who purchased L bonds from brokerage firms across the country, we suspect that Western International may just be the first firm to be charged with Reg BI violations by the SEC. As mentioned, over 120 broker-dealers have sold approximately $2 billion in L bonds to retail investors. While we're encouraged that the SEC has taken this action, we would have liked the SEC to go further in addressing the inherent conflicts of interest related to brokers maximizing their own compensation at the expense of customers. We believe that the SEC's enforcement action and lawsuit is primarily similar or could have been made under the suitability rule, and it didn't go far enough under the Reg BI regulation. Brokers often receive higher commissions for selling alternative complex products such as GWGL bonds. However, this raises serious conflicts, placing the broker's interest in direct competition with the investor's interest. We have seen many cases where a broker has justified the recommendation because it produces income for an investor with no appreciation for the risk or illiquidity of the product. After filing numerous FINRA arbitration claims and speaking with, again, over 80 GWGL bond investors, that's precisely what's going on here. Because of the widespread sale of these GWGL bonds from firms across the country, we believe that the SEC has an opportunity in future enforcement actions to make it clear that these sort of recommendations are inconsistent with Reg BI. We hope that there'll be much greater scrutiny with respect to these recommendations of high commission and risky products, particularly when they're sold to retirees or near retirees, which is precisely what we're seeing on the ground for these claims. I'm happy to answer any questions when we get to that point. Thank you so much.
Thank you, August. Ben.
Thank you again. My name is Ben Edwards. I'm an associate professor of law at the University of Nevada, Las Vegas, William S. Boyd School of Law. Many thanks again to the Institute for focusing on these issues and for advancing the conversation around these, and to our other speakers for bringing in their perspectives. So at the outset, I'd like to set the stage about how I see this. And ultimately, what this case illustrates, and the failure of Reg BI really highlights, it's a capital allocation problem for our economy. What I mean by that is, for capitalism to work in some meaningful way, you need money from savers and investors to make its way to companies to help them prosper or to get access to the capital they need, but also to flow in a way that makes sense to businesses that offer a reasonable risk of a reasonable possible return for an appropriate level of risk. And so what we have with GWG and many companies like it, in my view, are businesses that are essentially limping along. GWG here is alleged to have been losing millions of dollars, and they're able to stave off bankruptcy for a time, in part through doing all these debt offerings. And they're able to do this and to raise all that capital because of massive conflicts of interest in the broker-dealer space. Brokers are getting significant commissions for selling these products. The products themselves are making largely unrealistic, promises of interest rates, things that are well outside their likely ability to deliver. GWG can't really be faulted too much. In my reading of the SEC's complaint, it clearly disclosed the risks, and any reasonable person reading that would likely agree that this was probably a bad investment, probably a loser, and very, very risky. But the trouble we have is that most ordinary people need help from financial advisors to make decisions about where to put their money. And so they tell the financial advisor their rough needs, what their risk tolerance is, what their time horizon is, and they're supposed to hold their hand and help match them with investments that are right for their situation. They can't make risk go away, but they can match them in ways that are right. What we have happening across the board is investors who aren't looking to take very speculative, high risk positions are being shifted and pushed in that direction by brokers who are out often to make a buck. So for a little bit more context, I agree with the prior speakers that this is something that FINRA could have addressed under the prior suitability rule. Just for quickly recapture what that was, there were three main components to it. The first was a reasonable basis component. So the brokerage firm had to understand the product. The second was customer specific suitability. So they had to know things about the customer, and the product had to be right for that customer. And the last piece of it was the overall trading strategy had to be reasonable, which isn't as relevant here. But all you really need to know here is that this sort of enforcement action is something that FINRA could have brought under its prior rule. What this did not do and does not do is really move the needle on what it actually means for a stockbroker to be acting in an investor's best interest. So turning to what the SEC has done here, what its enforcement action here, you can think of it as largely procedural in some sense, that they don't need to really prove in order to win their case that this product was not in the best interest of this particular investor necessarily. All they have to show under the standard is that they weren't doing reasonable due diligence, and they seem to have those facts, and that the reps didn't understand what they were recommending. GWG used to be in the business of buying up old people or people's life insurance policies and then waiting on people to die. They changed their business model to where they're doing something entirely different. And these brokers were selling the product not understanding that the business model had fundamentally changed. And so for the SEC to win here and establish violations of regulation best interest, it doesn't necessarily need to show or convince anyone that these products really weren't in their best interest. It strikes me as much more focused on a failure to reasonably make attempts to comply with the form of regulation best interest. So what this enforcement action doesn't do is really flesh out what best interest actually is going to mean in a substantive and meaningful way. And that's going to be a very challenging thing for the SEC to do. And I can understand why the SEC might not have included that or pursued that in this particular case. Might be a more challenging argument in some circumstances, and it seems like it's got these winners, particularly against, in this case, for failing to do reasonable diligence, communicate that diligence to the representatives, or even understand what the product was when recommending it. Looking at this from another perspective, I can see this as a modest advance for investors in some ways. One is that the SEC bringing the enforcement action instead of FINRA means that there's going to be more publicity. There's going to be more attention to it because this is going to go through either the SEC system or the court system. Cases like this, you're going to have more publicly available information about what's happened than you would through the FINRA enforcement process against firms, and that can possibly help other investors bringing claims against other broker deals. So reading the SEC's complaint, one of the things I was struck by is just the information they had is often so difficult for ordinary investors to obtain in the FINRA arbitration. You're just trying to figure out how much money a particular broker has received in commissions. It's often a very difficult thing to even get through the FINRA arbitration process. But the SEC has it in its complaint, and it's set out in a nice little chart, making it very easy for people to understand. So I'd say there's a minor advance here, but I don't think that we really have an enormous advance on really forcing the brokerage industry to actually meaningfully put the interests of their customer first. And ultimately, regulation best interest doesn't even require that. All it requires is to these disclosure obligations, compliance obligations, and the way it defines best interest of the obligation is that it cannot put the brokerage firm's interest ahead of the retail customer. And that odd phrasing entirely avoids saying that the brokerage industry must put its customers' interests first, which is what an ordinary human would think when you were told that a broker has to act in your best interest. So with that, I'll turn it over to the Institute.
Thank you, Ben. Thank you very much. Thank you, August. Thank you, Chris. You made some great points. I want to sort of tie maybe a couple of things together by looking at this from a perspective of what should we have expected with Reg BI 4 years and 2 months into its life from the start of the proposal, and what did we get? And so I start on this by going back to April 2018. It seems like prehistoric at this point because of how things change. But let's ask this the basic question: what was Reg BI supposed to do? And on this point, again, I want to give the SEC credit whenever I can. And here the SEC, and I think the chair was very clear on what it was supposed to do. And that talks about, there are two things that to me stand out, and that is it was intended to raise the standard of broker-dealers, A, and B, it was intended to address this thing called investor confusion. And as Ben and August and Chris know, this thing, I call it the thing called investor confusion because I think it's much maligned and much misconstrued. It has been with us literally for 12 to 15 years, starting from the RAND report, when the problem with retail regulation was investors are confused. So that is part of the backdrop which this thing called Reg BI was supposed to address. So that's important in terms of what was supposed to have happened. And so that's April 2018. In June 2019, when the rulemaking comes out, Chairman Clayton says that, yes, the rule addresses investor confusion, quote unquote. And then the rule does something which it was good to remind myself. It actually spends a couple or 3 pages at the very beginning. And, this is a 770-page rule. So you can put lots of things in there that sort of can get overlooked. But right up front, they talk about the nature of the broker-dealer business. And actually, they point out some very important things about what their business is, and the fact that they have lots of built-in conflicts, and that these are inherent conflicts, include incentives to increase its own compensation at the expense of the customer. This is what the SEC says. And on one level, it's not surprising because it's what it is, but on another level, immediately thereafter, the SEC forgets all that and sort of moves in a totally different direction after they say that. So I say it's a good start, but then unfortunately it's a bad finish, because what the SEC does up front is to start talking about the differences between investment advisors and broker dealers, and then stops dramatically and does the opposite. And when I say it does the opposite is represented in the form, what we call Form CRS, where the implicit and explicit intent of Form CRS is to do the opposite. And that is to inform investors that, you know what, there's really not that big a deal of a difference between investment advisors and broker dealers. And when you look at their legal obligations, their conflicts, their services, they're pretty much the same. And that's what Form CRS does. And then to boot, they say, because they're the same according to the SEC, we don't even need this word called fiduciary anymore. And so they have essentially kicked out the word of fiduciary from the CRS and said, it's extraneous. It's extraneous now, according to the SEC. So that's a big piece in terms of where we have come in the last 4 years in terms of what the SEC has done. Now, I want to highlight just very quickly 2 other points that both August and Ben mentioned, and that in terms of data points. And the first one is the so important work of the North American Securities Administrators Association, NASA, in their November 2021 report, because guess what? They do an enormous amount of research in numerous states, and they come back with a simple conclusion. And that conclusion is, as expressed by Melanie Center-Lubin, the president of NASA, that most firms are operating, quote, in the same manner as they were operating under the suitability rule. That's sort of an important data point, and I think is too often forgotten. But so there's that data point, and then that's followed, 7 months later by another data point, which August went into, and that is the case that came out last week, and that case was championed by the SEC and by some outside the SEC as being sort of the first major enforcement case. And here, I think could not say it any better than Ben in terms of what the essence of that case was, in terms of being, and I think August said the same thing, in terms of basically being a suitability case, i.e. that it was all about the selling unsuitable products. And Ben mentioned why they chose this case, because guess what? That's a lot easier to pick out a suitability case than to do the hard work. And the hard work that was left open, that has been left open by the SEC, is what does a best interest standard for a broker mean in 2022? That's tough. But the SEC was very proud of the fact and boasted about the fact that they left that open, and that's to be determined. So instead of doing the hard work of starting to flesh out what it means so it can be useful to practitioners, investors, they took the easy route and said, let's just focus on basically a suitability case, and we will call it a Reg BI case, and everybody will be happy. And that's essentially what I think happened in that case last week. And so here we are today in June 2022. And looking back at what has happened in the last 2 years, what has happened in the last 4 years, and basically we have the suitability standard called something else, and that is what we are seeing in the marketplace. So on that case, I call this a unhappy birthday, because Reg BI has failed. It has failed to do what it was promised to do. And there's no question that it was promised to do that. And so, I think that's the bottom line. And so as I look at it, basically what's happened in 4 years is that Reg BI was launched by promising in part to raise the BD standard and to talk about or help investors understand how investment advisors and BDs are different. And now we've come around 4 years, and what it has done is essentially to lower the advisor standard in terms of what it's done, and it's informed investors that investment advisors and broker dealers are pretty much the same. So it has done a flip-flop in that sense, and I don't think that, I'm not aware that that's been acknowledged much in the industry in terms of what has happened. One final point before I stop, and that is that this is not a surprise to many people. And I go back to specifically in June 2019, one day before the rule came out, 3 consumer organizations, Consumer Federation of America, Better Markets, and PIABA, came together, and they said that Reg BI would be a step backwards. And guess what? They got it exactly right. And so kudos to those 3 organizations. So on that, I will stop and open up the floor to questions. And I can see the dean of the Washington advisor journalist is ready to pounce. So Ben, August, and Chris, be careful, because Mark is on.
Thanks, Knut. I suppose being the dean really boils down to just being here the longest of anyone on the beat. So for whatever that's worth. So you say that the case against Western Securities is a suitability case, not a Reg BI case. Could you give me an example of a charge that would have made it a Reg BI case? I mean, specifically, could you illustrate what a Reg BI case would be, and what are the characteristics we should be looking for?
That's a really good question. I think at the top of the list of what a Reg BI case looks like has to do with addressing those unanswered questions on what is a best interest standard based on fiduciary principles for a broker dealer in 2022. We could start with the 4 parts of Reg BI today. We could talk about conflicts of interest. We could talk about when is it more precisely that it is required to mitigate those conflicts of interest based on the judgment that the interests of the firm have been put ahead of the interest of the customer. And kudos to Ben for pointing out the fact that this is, first of all, a demotion by that wording it that way, but that's a separate point. But there's a piece right there. When is it required to do mitigation, and what does it look like? And there's one area where we could see a case. Another broad area where we could see a case is, what are the sorts of conflicts specifically that just generically must be mitigated. In the rulemaking itself, the SEC points out that some sales contests, not all, but some sales contests are ruled out, and that's in the category of I think a low-hanging fruit. So the whole issue of what conflicts generically require mitigation could be addressed. And then we start to get to define what best interest means. And as Ben said, that's hard work. That is hard work. But the SEC's had 4 years now to think about it, or you could say 2 years. And so I think there should be some effort in that area. Ben, you want to add something?
Yeah, so happy to jump in here. So one way to think about this is that regulation best interest absorbed much of the prior FINRA suitability rule. And so if you think about a Venn diagram where you have the FINRA, the pre-existing FINRA suitability rule, and then a bigger circle around that with regulation best interest. This to me doesn't push into any of that territory theoretically outside the suitability rule. Precisely defining exactly where that boundary line is always going to be very challenging because FINRA's guidance about what suitability meant previously included language that said broker-dealer firms had to make recommendations consistent with their customers' best interests, and exactly what that meant always remained very vague. And I think we have similar vagueness around what best interest really means in this context. But there are some things that do have a very clear meaning. One is you've got to have some due diligence. You've got to understand what the product is. You've got to have some process for matching products to customers based on what they've told you about their needs. In this case, I think really falls within that prior territory. And I can understand why the SEC starts here. What I would say is that my hope is that in the future we'll see more from the SEC once they've cut their teeth at this point. But I don't see this as the end, hopefully, of what the SEC will do here. There's certainly more room to run.
Thank you. August, anything you want to add?
Yeah, just briefly, just to echo what Knut and Ben had mentioned, is that I think that, and to answer your question directly, Mark, where the SEC enforcement action maybe could have taken it outside of the world of suitability with respect to making a suitable recommendation in the best interest of the client and having reasonable diligence, and taking it a step further into the world of Reg BI and what does that mean, is to do exactly what Knut mentioned, is to kind of address the inherent conflicts of interest that are related to brokers maximizing their own compensation at the expense of their customers. These cases, these GWG, I've been living this GWG thing since January. These cases are prime for that type of analysis, for that type of prodding or adjudication of the issue. There are examples of it across the country, as we've learned by speaking with a lot of individuals and doing and starting our arbitration cases. I believe that, and that's why I mentioned, I think there's an opportunity here for more cases to come down the line for the SEC against other broker-dealers, and hopefully that there'll be other cases where they do take that step and they do look to try to define that. I think the other one last thing is that, almost every individual that I've spoken to that purchased these L bonds didn't get an alternative investment recommendations. We all know there are hundreds of potential investments out there that could offer fixed income investments that could offer some sort of rate of income, and that might not be risky, or they might be moderate or conservative, variety of different alternatives. I can't tell you one that I can remember that actually has told me they've been offered anything else, and I wish the SEC kind of included that in their allegations more, instead of just a one-liner about it in each of the claims.
Thank you. Mark, any follow-up at this moment or not?
Just real quick, Knut, what you're talking about though, in terms of defining what mitigation means, define what best interest means, well, wouldn't that be better suited to SEC guidance? You're saying you want SEC litigators to tackle that? Shouldn't that be coming from the Division of Investment Management, not from enforcement?
Well, I guess part of me says I'll take it whatever way they want to give it, but it should be there. I find it really just awful that they don't do it at all. And so, since they have not done it, yet, and that maybe enforcement will be the way that it will be done. And when I think about this guidance, and I think about the difficulty of it, one case that I mentioned that goes back a bit in time is the case of Arlene Hughes, and that case had to do with a broker selling out of her own inventory and explaining to her customers what was happening. And that was to me, that was an excellent case for the SEC in explaining what informed consent meant. And so, I think of that as an example of using enforcement to define what the standard means. And anyway.
Okay. All right. Thank you.
Okay. Sam or Miriam, do you have a question for any of our esteemed speakers?
Yeah, I was wondering, August, you said you were talking, you've been talking to other investors who have invested in L bonds. I'm just wondering if you have a number of, as far as how many nationwide.
We've spoken to over 80 on my count. It might be more than that, but at least over 80 investors across the country.
Got it.
Anything else? Anything else, Sam?
No, that's it.
Okay.
I would add, Sam, that we represent about approximately 20 of those investors now currently.
Got it. Well, I can add too, like what a lot of this has focused on broker dealers, but would August or Ben, would you have any opinions on whether this has raised or changed the standard at all for investment advisors specifically?
So I'll jump in here. My view is that regulation best interest on the whole is creating problems for registered investment advisors, in the sense that if they're offering a higher standard of advice, it's very difficult now for them to distinguish themselves in a meaningful way for customers. Used to be they would say that they operate under a fiduciary standard, and that would be a strong signal that the kind of advice they give is different. And now with regulation best interest, it's more difficult for RAs to differentiate themselves in the market, and so I think that contributes to customer confusion more than it does away with it ultimately.
Got it. Thank you.
Miriam, do you have a question?
Yeah, I was going to ask big picture, if there's sort of, if rather than just the litigation solutions, or enforcement actions, do you see regulatory rulemaking that is, what would be ideal versus what is likely to happen? Do you see anything forthcoming with, a new administration, Barbara Roper, et cetera?
Ben or August, do you want to start on this? I'll follow you, or not.
So I don't have any particular insight into exactly what the SEC may be planning in the future. Actions like this, I think are probably ultimately good things for the SEC to be doing. Even though it doesn't move the ball as far as many of us would like to see it go. But the hope is that the SEC will continue thinking about this and thinking about what it can do to meaningfully raise the level of advice that retail customers are receiving from broker-dealers. And that may mean ultimately more regulatory guidance, helping to flesh out exactly what the SEC's view of best interest is.
Thank you. Miriam, I think that's a great question, and because I think that's acknowledging that we are now 13 months under what I've referred to as the new SEC, with the new chair, and I think from a historic perspective, and I've written about this, we have the most investor-centric, fiduciary knowledgeable SEC commission than we've had probably since Arthur Levitt was there in his first years. Period. End of sentence. I think there was a reason to believe that we would see a number of different things happening with this new SEC, and so I think from a big picture perspective, we had reason to be optimistic. Now, 13 months later, I think the picture is cloudier. Now, we're 13 months into it. Maybe we're in the beginning of the second quarter of a 4-quarter game, or maybe not, in the sense that the elections are looming. And if it were to be a case that we have a very big win on the Republican side, I'm not saying we will, I'm saying if it were, that could change the chairs on the ship a lot by itself. So A, I think it's a good question. B, I think that we should be optimistic that this SEC is going to do things different. But we live in a crazy world. I never in my life would have expected this SEC to basically eliminate the word fiduciary from its most prominent 2-page form called CRS, which it did 2 months ago. I'm still stunned by that. So there's surprises every day. So I'll stop there. August, do you have anything you want to add to that? Or Chris, from the investors from Florida?
I don't have any more insight to add on whether there's going to be any additional rulemaking. I haven't heard anything, and I would, aspirationally, we always hope that there will be, and hope that the standards get more defined and pushed towards a true fiduciary standard. But I don't have any actual insight on any new rulemaking or any potential new rulemaking, and I think that Knut's thoughts about the potential next few years with elections coming up might prevent anything from materially happening, but that's just my opinion.
My view is what do I think would work based on my vantage point? That would be, I guess you would call low-hanging fruit, to the extent that it, at least from my vantage point, appears to be something that could be relatively simple to do, in my view, and would make would go a long way in terms of helping the public understand. My view is that if you are a dual registrant, or you work at a broker dealer, or you are a representative of an insurance company, that you must have the word sales in your title. I think this would go a very, very long way in kind of helping people understand. So and maybe also making the use of the word advisor off limits to those certainly who aren't registered as such under the Act, the 40 Act, and then also any profession, it seems to me, has some sort of protections around the use of its titles. I mean, we're sitting here with two lawyers. I mean, unauthorized practice of law is a real thing, right? So, from my vantage point, there are a lot of things that could be done, and some of those are simple. But that to me, that is the very top of my list. Let's define and protect titles. And so when somebody gets a card or somebody looks up someone in this industry, let's call it, or profession, and they see the word sales in that title, then they know. And if they don't, then they know. I mean, how elegant is that? But again, I sit down here and scream a lot.
Thank you, Chris. We haven't heard, Helene, did you have any questions or for any of our speakers?
Hey there. I mean, Miriam basically asked my question. I mean, which was basically, is there, any hope of this getting, revisited at some point? I guess the other thing I would ask is, do you think we're going to start seeing more in the way of either actions or just simple scandals, as the sort of tide has been receding on the stock market and pretty much every other form of investment over the past few months? As we all know, lots of sins get hidden when everything's going up, and lots of stuff starts coming out when everything starts going down. So I was curious if you thought that might make a difference in all of this.
Ben or August?
Yeah, I certainly think that you're going to see more actions because of what's going on in the stock market. A lot of times those take a little bit of time to come through, and there's a little bit of delay in getting those in finding or seeing those actions come through, whether it be an enforcement action or civil actions. There's usually some sort of delay between when the losses actually occur and when those actions come to light. There is a great quote that I love to use about that, and it was a quote by, just trying to find it.
Is this the Warren Buffett quote?
Is it? Yeah, I was thinking Warren Buffett.
Oh,
When the
yeah.
tide goes out?
When the tide goes out, you find out who's swimming naked.
Yeah, when the tide comes out, you find out who's swimming naked. That's a great quote, and I think that that's going to happen. Whether that has an impact overall on Reg BI or a review of the fiduciary standard, I think remains to be seen. But just because of the natural lag in the process of that, you probably wouldn't have any impact anytime in the interim near future.
Yeah. So to jump in here, one of the things about a rising market is that it often covers up a lot of really bad behavior. So brokers will recommend products that are too risky or inappropriate for customers, and the customers will get good results for a period because they're taking more risks than they should, and the market's going up, so everything looks great, and they think their financial advisor has really been helping them. And then if the market turns, the thing the advisor is supposed to be doing ultimately is positioning them to be, to manage their assets reasonably prudently in light of their needs, to protect against something like that. And what we tend to see is that you only really get accountability for this kind of conduct when it generates losses for investors. And so ultimately I do think in light of market developments that we're going to see more and more activity in this space, and what it ultimately means and how it changes and shifts the standard over time, we're gonna have to watch.
Thank you, Ben. Helene, did you have another question?
Can I ask one other quick question?
Yeah.
And I realize this is slightly off the subject of the SEC, but what is your thinking on the situation with the Department of Labor's fiduciary rule right now, which is, which is, if I'm remembering this right, is the one that was, adopted under the Trump administration. And how do you think that is playing out? And if that's
Ben,
a separate question from this conversation, that's fine.
No. Ben, do you want to take a stab or pass?
Well, so I haven't. I don't want to speak specifically to the current regulatory developments, but after the Fifth Circuit decision and the Trump administration largely abandoning it, I don't think. The sense I had was that they were, largely looking to follow what the SEC was doing, at that point. So there may be some changes happening in that space right now, and I remember some conversations around that. But I don't want to be, I don't want to give a comment on it at this time.
Okay. Thank you.
Out ahead of my skis.
Okay. I think I got ahead of everybody.
No. In fact, Phyllis Borsey might have been on this call just to listen in. She's on our board and she's very interested in these things, of course, but she's not here. So, but we can do that another time.
Okay.
August, did you have anything to add on that at this point or not? Can't hear you. There you go.
There we go. On the DOL rulemaking.
Yeah. Did you have anything you wanted to add? You don't have to.
I was looking at my notes because we actually I spoke to a couple of congressional members, staff's offices last few weeks on it. I don't really have anything right now. Helene, if that's something that you had a question on, I'm sure I can kind of you can circle back on it, and I would be happy to.
Okay. Mark, did you have any last question?
I know I was going to say I actually have to get to another meeting, but Knut, real quick, with a very short answer, what do you suppose the chances are the SEC comes out with a 20-page, single-spaced, dense piece of guidance at 4:50 p.m. on June 30th, the second anniversary of the implementation, about Reg BI that answers all of your questions and puts this situation to rest for you? They tell brokers how to mitigate. They tell brokers what best interest means, and it's all right there in that 20-page single-spaced memo that comes out just before 5 on the second anniversary. What do you suppose the chances are of that?
The same chances that I'm going to get a seat on the next plane to Mars.
Okay.
That's about the chances. But I would settle for enforcement actions that address these step by step, substantively. So anyway, okay.
Thanks.
We are at the top of the hour. Unless Miriam or Sam had a final question, we can close it off for now. I want to thank Ben and August and Chris for speaking. And again, if there are any follow-up questions, I think you know where to send them, and if you send them to me, I will send them along to the right individual. So thank you very much. Thank you, Elizabeth Patrick, for running the control panel, and we look forward to the next one. All right. Have a good rest of the day and a good weekend.
Thanks everyone. Thanks, Knut, Ben and August.
Thank you for a very interesting conversation. Thank you.